I have had the great opportunity of working with our next speaker on a number of different cases. Let's see now, we're up in South Dakota together, huge corporate clients of mine in Texas. Bunch of course, obviously folks from here. One of our clients is a couple of generations that we're working with to figure values of the company. So in terms of transitioning the value, they manage something like 4,000 doors, real estate doors. Let's see, an avocado rancher client of mine. It's kind of like, I can't seem to give this woman anything that she can't handle. I mean, it's just like, okay, bring it on. But it's important both as a business owner, as well as if you're going to be selling an asset or if you're buying out a partner, there's just a number of different times when you need to know what's your business worth. So Cheryl Kessler is just not only, let me say, for those of you out there who still think that blondes are dumb, you will not think that when you finish hearing this woman speak. She's got the goods. So Cheryl, thanks so much for being with us.
Thank you. Thank you very much, RJ. So I'm Cheryl Kessler, and I'm a director with Brennig Taylor Zimmer, and I specialize in business valuations and also forensic accounting. So what the heck is forensic accounting anyways? It's anything in regards to numbers where you have to testify in court or in a deposition or mediation, that kind of thing. And primarily I do it in regards to divorce and partner buyouts. So what I'm going to talk about is when you need a business appraiser, what the qualifications to look for. I'm going to talk a little bit about buy-sell agreements, and then I'm going to talk about how to value a company and how to increase the value of your existing company. So when is a business valuation needed? Obviously, the first thing people think about is mergers and acquisitions. You know, I'm selling a company, I'm buying a company, but it's not just that. It's anything where there's a stock transaction. You know, it could be employee incentives, anything in regards to stock. And it's also for tax and financial reporting. So a good part of my business is for estate tax and gift tax, and it's operating companies, and it's also valuations of real estate holding companies, LLCs and limited partnerships that own all kinds of real estate. I don't value the real estate, but so anything in regards to tax or IRS as well. And then of course litigation. And so that involves, you know, shareholder disputes, partner buyouts, divorces, and that sort of thing. So when you're looking for a valuation expert, you want to make sure that they have the proper credentials, right? So here are some of the credentials that you look for: CFA, ASA, and then if your CPA says, oh yeah, I can value that company for you, ask them if they have an ABV designation, which is accredited in business valuation, and make sure that they do valuations as part of their practice on a regular basis. So buy-sell agreements. The first question I ask is, do you have one? And of course you only need one if you have multiple partners or shareholders, right? And then even if you say, oh yeah, Cheryl, I have one. Well, when did you last look at it? Was it 15 years ago? Is it even still relevant? You know, what is in it anyway, right? And so if you have multiple partners, it's really important to get a buy-sell agreement. And because it really talks to what happens when one of the Ds happen, right? Disagreement, divorce, disability, death, right? But also, what about retirement? You know, business owners will exit their business. It's just a matter of when and how. So buy-sell agreements, you know, one of the things that happens, and they can talk about, you know, if somebody's leaving the business, what's going to happen is, are the other shareholders required to buy that other shareholder out, or do they have the option to buy? So I had a client who was a 45% shareholder in a firm. The other shareholders decided they wanted her out, okay? And so they fired her, and she was left with 45% interest in a privately held company. They had the option to buy her out. Well, so now she's sitting here with stock and is not even a part of the business anymore, right? So a big problem for her, she can't access that value. So buy-sell agreements also establish the valuation methodology. How are you going to value that company? Who's going to do it? What's the process going to be? And one thing that I am very particular about that I do not see very often in buy-sell agreements is the requirement to pay taxes. And you're like, what are you talking about, Cheryl? Well, most small business owners are pass-through entities or business entities. They're S-corps, they're LLCs, they're partnerships, right? So you pay taxes at the individual level via a K-1. Well, what if you own 10% in a company and the controlling shareholders say, you know what, we're not going to distribute any cash. So you get the joy of paying taxes on the business income with no money to pay for it except for your personal savings account. And I had a client that came to me. She was a 33% holder in a business. Her two brothers were the other holders. It had been inherited from their parents. The brothers worked in the business. She did not. They wanted to buy her out. And so what they did is they said, you know what, we're just not paying cash distributions this year. So she got taxed on the income. And so here she's sitting there going, I want out. You know, I'm sitting here having to take money out of my pocket and I need to get out of this. And so she ended up having to sell her shares at a substantial discount, right? So not a good thing. Make sure that these are in your buy-sell agreements. So they also talk about how the other person's going to buy out. Can they afford it? You know, is it going to be a cash sale? Is it, you know, going to be a note? Is there life insurance that's funding it? You know, how are you going to accomplish this sale? Okay, so another big thing that people don't realize, business owners, is what the heck is fair market value anyways? It's what a willing buyer, willing seller would pay, right? Oh, okay, you know, we're done. We've handled the valuation methodologies, right? Well, what people don't realize, if you own less than 50% of the business, fair market value to me means with minority and marketability discounts. And those discounts can be anywhere from 25 to 50%. Did you know you're going to be discounted when you get bought out by that much? You know, most business owners don't know that. The data valuations sometimes can be critically important. And also, when you dictate to your business appraiser how they're going to value the company, you want to know how they're handling taxes in the income approach. Because pass-through entities don't pay taxes, right? So if you want a high value, you want the business appraiser to put no tax affecting on the business. The entity doesn't pay taxes. You know you're paying it out of your personal account, right? But the entity doesn't. So then you get a high value if you apply no taxes. If you apply C-Corp taxes, you get the lowest value. So I guess it depends what side of the coin you are on, right? But these things need to be established up front so everybody knows how they're handled, because that provision in particular can also be 2 times the value. And people don't understand that. So what I recommend is, you know, have a business appraiser review your buy-sell agreement, first of all. Not just your corporate attorney, not just your CPA or other advisors. Have someone that's going to be implementing it when something happens, right? And have them establish a current value so you know what the value is, your business is, so your other partners know what the value is and they don't have unrealistic expectations, right? And it'll make it a little easier when there's a buyout if there's some knowledge on the half of the shareholders is what the business is worth. So how the heck do I value a business anyways? You know, what do you do, right? So, you know, one of the things that happens with me is I have business owners come to me, particularly in divorce situations, and the first thing I have to do is say, is this a job or is it a business? You know, especially with construction contractors, services firms, you know, real estate agents, right? You know, is it just a job? And so I need to figure out, first and foremost, if there's cash flow above market compensation. So what do you have to pay somebody? If you want to just retire today, I'm going to hire someone to run the company, what do I have to pay them? And if there's cash flow above and beyond that, then there's probably some business value, right? It's not just a job. But I have sometimes people that they're not even making enough to pay themselves a reasonable wage. that's a business that has no value except for its tangible assets. And I have one of those on my desk right now. So one thing when you're valuing a business, and as a business owner, you want to keep in mind, higher cash flow translates to higher value, right? So one of the first thing I do is I look at, and a business broker will do this too, is they look at, what are the non-cash expenses, depreciation and amortization, and you add that back to earnings. And then you also add discretionary expenses, also known as personal expenses, to the business. And then finally, you add back non-recurring expenses. So that's like large expenses. Maybe there was a lawsuit and it's not going to continue going in the future. And what you're trying to do is figure out what is the cash flow that essentially a buyer can expect to achieve going forward. What's a normal cash flow for this business after you add back all the junk that's intended to reduce your tax bill, and you take into account some of these non-recurring items. Reasonable comp, we talked about how important that is, and so I always look at certain databases, salary databases, to figure out what is it. And sometimes business owners wear many hats, and so replacing that business owner may require hiring a controller or a VP sales or whatever it is in order to replace what that business owner is doing. And then we subtract from all of that add backs economic depreciation. And that's the annual investment that you have to make into your business to sustain the operations. So I'm going to run through a quick example. Of course, this is a former client. It was a manufacturer, about 20 employees. Of course, the owner was very key to the operations. And so here's some numbers. We all like numbers, right? So adjusted EBITDA. What's EBITDA anyway? It's earnings before interest, taxes, depreciation, and amortization. So that means you take your income and you add those things back, right? So I determined that market compensation would be $200,000 for this business, and the economic depreciation is $30,000. So the resulting EBIT, also known as operating income, is $238,000. Okay? So keep that number in mind. So we start now with the 238, and we're determining our free cash flow, right? In this case, it was a C corporation, so I took out the new C corp tax rates, and you're like, what happened to the 21%? No, that's state and federal, okay? And then we take the economic depreciation out, a working capital adjustment. So our free cash flow for this business is $167,500. So there's 3 legs to the stool when you're valuing a business. So you've got the income approach, the market approach, and then the cost approach. And there's a couple different options in the income approach and market approach that you could use. In this example, we're going to use the capitalization of earnings approach for the income approach, and we're going to look at sales of other businesses in the industry. Okay, so that $167,000 of free cash flow that we got from the other page, we're dividing it by a business cap rate. So it's very similar to commercial buildings. Commercial real estate appraisers also do an income approach, a market approach, and a cost approach. However, their cap rates are different. They're using real estate cap rates, I'm using business cap rates. Okay, so this business is $117,000 in business value, of which $500,000 approximately is the tangible assets, and then $600,000 is the goodwill or intangible assets. Okay, so now let's look at the market approach. So I went to our databases to find other businesses in the industry that sold, and what did they sell for? What market multiples were they sold for? What does that mean? So a market multiple is the deal price, the sales price, divided by revenues, and it could be divided by seller's discretionary earnings, which is simply just EBITDA plus owner comp. So nothing more than that. I could have also used just straight EBITDA, okay? So the market multiple for the revenue is 0.5 times for the industry, and the seller's discretionary earnings multiple was 2.25 times. Okay, so we apply that to our subject company to come up with indications of value for the business. Okay, and then these are deal prices based on asset sales. So the business has sold the assets, they didn't sell the stock. And so what does that mean? In an asset sale, typically working capital, or current assets less current liabilities, is not included in the sale. So if we want to know what the assets of this business are, we have to add those in. Okay, so here's our 3 different approaches. We have an income approach at $1,000,001, a market approach at $1,000,002. Oh, and look at the cost approach, which is basically the fair market value of the tangible assets, only $500,000. So if your buy-sell agreement says book value, that's what you're going to get. Okay. So if I'm a business owner, what can I do to increase value of my business? The first thing that's not on this slide is timing. We're in an economic expansion. We don't know when the next recession is going to be. You want to sell when things are good, right? Because when you're in a recession, trying to sell a business is very difficult. Your cash flows are going to be down, and you're just not going to get the same sales price as you can in a good economy. And also sometimes those market multiples I was talking about also decrease. So you get a double whammy in a recession. So make sure that you sell when things are good. So that's the single biggest thing you can do. But also, look at, if you're a business where it's solely dependent on you, look at finding people, middle management, that can take some of those responsibilities off so that when you're transitioning to a buyer, it's not just all you, because a buyer is going to be really concerned about buying a company. You're running it and then you retire. What does he do? What does he do then, right? And the buyer wants to know that they can make a profit after they buy the business, when they pay somebody a reasonable market compensation for the company. And, if you have a business model that allows for recurring revenues, and I would, give an example. Maybe there's a CPA firm where they do annual tax returns, or a subscription-based service, or anything where you have recurring revenues. You want to emphasize those and get as much as that as you can, because that's really a value to a buyer, because they know that those revenues are going to continue after the sale. And it's much easier to sell a business and get a good price when your revenue and EBITDA are increasing, right? But what if it's going like this, right? A buyer's going to really discount the price a lot, right? So you want to try and make sure that you're keeping the trains on the track, right? And so you can see also why, as you're going into a recession, it really makes it difficult. And try and really look at your product mix or your services mix and focus on the high profit margins, because buyers really like high gross profit margins. And maybe there's some changes you can make now that'll increase your profitability. Diversify your customer base. The biggest, oh my gosh, I had a client, a big telecom company. They were doing $90 million a year in revenue. I came in to do a valuation for a stock plan, and they had a 90% customer concentration, right? Think about the risk to somebody buying that firm. And what happened was, a year or two later, that customer decided they were going to do some of it internally. Their revenues went basically overnight from 90 million to 60 million. They had to shut down a plant overseas. I mean, it was, right? So it's a big deal. So diversify your customer base. And if you're big enough and you have the ability, if you can increase your EBITDA over 2 million, you open yourself and your business up for private equity buyers. So now all of a sudden you have a lot of private equity firms and more people interested in buying your company, all right? And then also, if you can, protect your intellectual property. Talk to intellectual property attorney and see what you can protect. So I'm just going to summarize here. So obviously, I think it's really important to implement a buy-sell agreement if you have multiple shareholders. And if you're an advisor, ask the question, do they have one? When's the last time you looked at it? Let's take a look and see if it says what you think it says. And, make sure you understand what your true business income is. And if you are running personal expenses, clean up your accounting, ahead of time. There's nothing worse than to have personal expenses through every expense category in the profit and loss statement. Maybe keep it to autos and meals and entertainment or something, right? And get a baseline valuation way ahead of time so when can I retire? What's my time horizon? You can plan. We're in a good economy now. Is now the time? Or am I okay with waiting till, the next cycle? And, look at the things I just talked about to grow value and increase the value of your business before you do decide to sell. So are there any questions? Oh, thank you.